Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Dr. Derek Hosmeyer, professor at George Mason University School of Business. Dr. Hosmeyer is also a regular contributor to the Wall Street Journal. We are talking about taxes and some tax moves that investors should make before the end of the year. Dr. Hosmeyer, welcome back on the show.
Hi, thank you for having me, Neena.
So I usually recommend that investors should take a look at their investing goals and review the progress that they are making and whether any change is required in their asset allocation to reach those goals. But let's focus on some of the tax moves today. And in particular, I wanted to talk about tax loss harvesting because you wrote an article which was published in the Wall Street Journal recently. You wrote about the real impact of tax loss harvesting and what investors should do about it. So tell us, what is tax loss harvesting and how does it impact stock prices at the end of the year?
Sure, of course, yeah. So tax loss harvesting is the practice of selling a stock that has had a capital loss. I'm going to call these loser stocks. So it's selling loser stocks at the end of the year to reduce capital gains and reduce one's end-of-year tax bill. The interesting thing is that this tax loss harvesting has a real profound effect on kind of the spread between winners and losers, especially at the very end of the year in the month of December. So to kind of get into this issue, I looked at the past 25 years of returns for all stocks listed on the New York Stock Exchange and the NASDAQ, and then I separated them by whether they were winners or losers for the first 11 months of the year. And the interesting thing is there's a big difference, again, due to tax loss harvesting between winners and losers in the month of December. On average, a winner stock will have a 1.46% return, and a loser stock will just have a 0.35% return in December. So this is a spread of over 1 percentage points, which is highly significant in the month of December. And the interesting thing is this is really concentrated in years where the stock market has gone up a lot. The spread gets bigger and bigger when you look at years where the stock market has gone up over 30%, which is kind of what we're approaching right now. Mm-hmm. So most of this is concentrated in what I call boom years. And it kind of makes sense because in boom years, there's very few loser stocks that you can tax loss harvest with. In the month of December, these loser stocks have incredible sale pressure in month of December when it's a boom year. And we actually see the spread between winners and losers going up to almost 3% in boom years.
Very interesting. So what is the takeaway for investors? What should they do?
Sure, yeah, that's a very good question. I think the number one takeaway, especially given that we're in a boom year, we can expect losers to probably suffer really badly in December. Again, driven by everybody selling off their loser stocks to tax loss harvest. So to get ahead of this, we would hope that, don't wait till middle of or end of December to tax loss harvest. Take care of it early. Take care of it now, which, early December. That's kind of the best approach. And if you are a really, really bold investor, there's, kind of what we call a market neutral strategy you can implement here where you go long the winners and short the losers. But again, I'm not advising that everyone try that. But again, if you're feeling really bold, you can go long the winners and short the losers in December and make a little bit of money without taking on considerable market risk.
So now let's talk about capital gains distributions by mutual funds. So mutual funds that have sold their underlying holdings and recorded gains, which may be many mutual funds this year because the S&P 500 is up almost 23% year to date. So these mutual funds, they typically distribute those capital gains to their investors, typically in December. And particularly actively managed funds that have higher turnover, they distribute these capital gains. And so many mutual fund investors may get surprise tax bills this year, even if they haven't sold anything. And this is not a problem for mutual funds that are held in tax deferred accounts, but for taxable accounts, these gains create a tax liability. So tell us a little bit about these capital gains and what can investors do to minimize such taxes in the coming years? Probably they should decide which investment should be put in tax sheltered account and which in taxable accounts. And maybe some families of mutual funds are better at managing taxes than others.
Yes, completely, yeah. So I guess the first step would be to identify really tax inefficient kind of vehicles. And we've kind of, over time, many professors and practitioners have observed, REITs and other high yield bonds and these other kind of things are tax inefficient. So if you are going to hold those in your portfolio, it's best to allocate them to a tax sheltered account, or at least overweight those positions in a tax sheltered account. So if you want to have REITs being 10 or 15% of your portfolio, probably best to hold them in something like an IRA or a 401k. The next step to kind of minimizing taxes here would be to obviously invest in the most tax efficient ETFs or mutual funds. And just like you mentioned, mutual fund turnover is one of the biggest determinants of tax inefficiency. And really, as an investor, you can't control that. The only way you can control it is to pick, the mutual funds that don't have a lot of turnover. So, like you mentioned, even if you don't sell a stock or the mutual fund, you may wind up with a tax bill because the mutual fund manager is selling stocks behind the scenes. And you're exactly correct. Since we've seen a lot of outflows out of actively managed mutual funds, these have been the least tax efficient. So I would highly recommend, kind of avoiding actively managed mutual funds that have had a lot of turnover. And so the cheapest option usually is to go with an index mutual fund if you are going to invest in mutual funds.
So you mentioned REITs, and REITs have been really popular. REIT ETFs have been really popular with investors this year. Yeah, REIT ETFs like the Vanguard REIT ETF, ticker VNQ, that has done very well, particularly earlier this year because rates were so low. So that is better suited for tax sheltered accounts.
Exactly.
And talking about actively managed mutual funds, you had also studied the performance of actively managed mutual funds and how they failed to beat the benchmarks. Could you tell us a little bit about that?
Sure, yeah. I've looked into that quite a bit. Actively managed funds, a lot of them like to pitch that, they can beat the benchmark, but usually in a typical year, we're seeing, only about 30 or 40%, way under the 50% mark, that are actually beating their benchmark. And most of them are tax inefficient. So on an after-tax basis, you're getting kind of hurt double. You're paying higher fees. They're not matching their benchmark. And then you're paying a greater tax bill at the end of the year. So all in all, most actively managed funds now are really vastly underperforming the index. I actually took a look at kind of active management around the world, and even around the world that kind of holds true. There was one little bright spot, which was actively managed mutual funds in India, of all places, where
That's
they
interesting.
kind of tended to beat the benchmark.
Mm-hmm.
But that was about the only one place where we saw positive signs for actively managed mutual funds out there.
So, talking about ETFs tax efficiency, in 2018, 62% of mutual funds paid capital gains distribution, which resulted in tax liabilities for investors if those mutual funds were held in taxable accounts, while only 5% of ETFs paid capital gains in the same year. So many investors do not understand why ETFs are more tax efficient compared to mutual funds. It's because of the way they are structured. So could you tell us a little bit about that?
Sure, of course. So first off, ETFs are generally more tax efficient just because, they are fundamentally, or most of them are fundamentally, a type of index fund. So they have little turnover. So they accrue fewer capital gains. Also, the interesting feature of an ETF is that it redeems shares in kind. Now, this term called redeem shares in kind is a really clever way that the ETF is structured where they can avoid a taxable sale. And so since ETFs can redeem shares in kind, this avoids a taxable sale, and which in turn means no capital gains. Mutual funds do not have this advantage. They can't redeem shares in kind. So when there is a sale, it does mean a taxable event. So ETFs, just due to their structure, have this very interesting kind of structure, and it really minimizes capital gains. And the other interesting thing is that this benefit of redeeming shares in kind is especially true for equity ETFs. So equity ETFs are actually much more tax efficient than bond ETFs because of this ability to redeem shares in kind.
I would just like to add that not all ETFs are tax efficient. Most of them are very tax efficient. For example, inverse and leverage ETFs, they reset daily and they may realize significant short-term capital gains. And currency hedged ETFs, which are very popular in certain years, they use derivatives like forward contracts to hedge out the foreign exchange exposure. And so they also need to distribute capital gains to investors in some years.
That's a very good caveat, yes. So I always warn my students, stay away from, they all want to invest in leverage ETFs, 3X or minus 3X ETFs, and I spend a whole class or two explaining to them why they need to avoid this. And, taxes are one issue where they're much less efficient, and then just, leakage and all these other issues that come with leverage ETFs. So I couldn't agree with you more. Please avoid leverage ETFs out there.
Yeah, they are best suited just as short-term trading or hedging tools, mainly for traders or professional investors, not for individual investors. Now, switching gears a little bit, I wanted to talk about another very interesting topic, and I saw your research about risks of investing in unprofitable companies. So tell us about that.
Yes, so the next Wall Street Journal article that'll come out in about a few weeks kind of focuses on unprofitable companies. There's been a lot recently kind of written just on how many unprofitable companies there are out there. In fact, about 70% of our IPOs last year were of unprofitable companies. And when we look at our markets as a whole, when you add up all the companies listed on NASDAQ and the NYSE, we're at a 20-year high for the fraction of unprofitable companies that are listed out there. We're up to about 35% now. And so I was kind of curious about, why are people investing in these companies? And I wanted to highlight, one of the main risks that people don't seem to kind of consider when looking at an unprofitable company, it's the type of risk that we usually talk about with bond investors, and that's what we call duration or interest rate sensitivity. And so in this article coming up, I kind of highlight just how bad unprofitable companies have done over the past 20 years. Unprofitable companies, on average, underperform the profitable companies by about 2 or 3% per year. Not only that, they are considerably more risky, both in terms of our standard definition of risk, which is volatility, but also they have considerable interest rate risk. And that's kind of at an all-time high now, given that interest rates are so low. So typically we only think of interest rate risk when we talk about, bond portfolio's, but if you're investing in unprofitable companies like Uber or Lyft or, Peloton or, the list goes on and on and on of tech companies that are, kind of not profitable, you're taking on considerable interest rate risk when making that investment.
Very interesting. So takeaway for investors is that avoid investing in loss-making companies?
Yes, yeah, exactly.
So the good thing that we noticed this year, it seems that investors are losing appetite for these loss-making, particularly IPOs, and particularly with founders that have outsized control. Look at the entire WeWork saga or price performance of Uber and Lyft. It seems that investors are becoming wiser now.
Yes, I think, I kind of touched on that in the article, but I think that WeWork failed IPO may have been a turning point. I mean, we'll see, because again, that was just a few months ago. Yeah. But it really seemed to be a shift in kind of the way equity investors out there think. That was a big market upheaval, and ever since then, we've seen, Uber's down, I think, 30% this year. Lyft is down a lot. There's really almost kind of a rebellion, a mini rebellion kind of taking place against these unprofitable companies. Yeah.
Very interesting. That's all we have time for today. Dr. Hosmeyer, thanks for joining us.
Thank you very much.
Thanks for listening. Please visit DerekHosmeyer.com if you want to learn more about Dr. Hosmeyer's research. Make sure to be on the lookout for the next edition of ETF Spotlight, and also remember to subscribe. If you have any comments or questions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.